ETFs, or exchange traded funds. I'm sure you have heard one of these terms before, especially in the past couple of months, weeks, or days. If you have not, now is definitely the time to get to know some of these concepts. In today's easily comprehensible video, we will help you do just that. So without further ado, my name is Daniel, and welcome to the Greenwave. An exchange-traded fund, or ETF, is a type of pooled investment security or a basket of securities that operates much like a mutual fund. Now, a mutual fund is a financial vehicle that takes or gathers assets or money from shareholders to invest in securities like stocks, bonds, money market instruments, or other assets. Simply, the individuals running a mutual fund will take your money and attempt to produce capital gains or income for you, so for the investors. Typically, ETFs, which are different to mutual funds, will track a particular index, sector, commodity, or other asset, but unlike mutual funds, ETFs can be purchased or sold on a stock exchange the same way that a regular stock can. An ETF can be structured to track anything from the price of an individual commodity to a large and diverse collection of securities or stocks. ETFs can even be structured to track specific investment strategies. The first ETF was the SPDR S&P 500 ETF with the tracker symbol SPY or SPY, which tracks the S&P 500 index and which remains an actively traded ETF today. ETF share prices fluctuate all day as the ETF is bought and sold. This is different from mutual funds, which only trade once a day after the market closes. Moreover, ETFs can contain all types of investments, including stocks, commodities, or bonds. Some offer US-only holdings, while others are international. Additionally, ETFs offer low expense ratios, which mean it doesn't cost you a lot to buy or sell an ETF, and they also include fewer broker commissions than buying the stocks included in the ETF individually. ETFs are generally characterized as either passive or actively managed. So firstly, let's look at the passive ones. Passive ETFs aim to replicate the performance of a broader index, either a diversified index such as the S&P 500 or a more specific targeted sector or trend. An example of the latter category is, for instance, gold mining stocks. Contrarily, actively managed ETFs typically do not target an index of securities, but rather have portfolio managers making decisions about which securities to include in the portfolio. These funds have benefits over passive ETFs, but tend to be more expensive to investors. This is because the active managers naturally need to be paid, since nobody works for free, and that results in increased fees for investors. Now, there are many other distinctions that could be drawn between other types of ETFs, such as bond ETFs, stock ETFs, commodity ETFs, currency ETFs, inverse ETFs, or leveraged ETFs, but for the sake of simplicity, we will leave that for future videos. Instead, now let's look at the pros and cons of ETFs. Certainly, ETFs provide lower average costs for the investor because it would be more expensive to buy all the stocks held in an ETF portfolio individually. With an ETF, investors only need to execute one transaction to buy and one transaction to sell, which leads to fewer broker commissions because there are only a few trades being done by the investor, and so brokers typically charge a commission for each trade. Furthermore, some brokers even offer no commission trading on certain low-cost ETFs, reducing costs for investors even further. And in addition to this cost and convenience benefit, ETFs also help with risk management through diversification. On the other hand, we have the disadvantages. So the aforementioned actively managed ETFs often have higher fees. Certain single industry-focused ETFs limit diversification, and what's more, if a particular ETF is not very popular, there may be issues with liquidity, hindering transactions. Thus, there might come a time when you will want to sell your stake in an ETF, but there will be no one willing to buy it from you. However, this risk is essentially non-existent with some of the more popular ETFs, and this risk also comes with buying individual shares. The last disadvantage, or a concern you might say, of ETFs is something that was highlighted even by their creator, Jack Bogle. This concern has to do with the fact that many retail investors buy various ETFs without necessarily knowing what said ETF includes, and this large amount of capital pouring into these funds may pose issues in the future crises. Just to put it into perspective, this is how the amount of money invested in ETFs has grown over the past decades. In 2003, the number was measly $200 billion, whereas in 2021, we're almost touching $10 trillion at 9.94 trillion exactly, and that is a huge amount of money that is invested in these exchange-traded funds. Now to move on to the last section of the video, let's look at some of the most popular ETFs and what they track. Firstly, the aforementioned S&P 500 or SPY ETF is the oldest surviving and most widely known ETF that tracks the performance of the S&P 500 index. Secondly, we have the iShares Russell 2000 or IWM that tracks the Russell 2000 small cap index, which is mostly smaller companies that are left out of the S&P 500. Next, we have the Invesco or QQQ that tracks the Nasdaq 100 index, which typically contains technology stocks. Then we have the SPDR, Dow Jones Industrial Average, or DIA, which represents the 30 stocks of the Dow Jones Industrial Average. Additionally, sector ETFs track individual industries and sectors such as oil, OIH, energy, XLE, financial services, XLF, real estate investment trusts, IYR, and biotechnology, BBH. Commodity ETFs represent commodity markets, including gold, GLD, silver, SLV, crude oil, USO, and natural gas, UNG. Additionally, country ETFs track the primary stock indexes in foreign countries, but they are traded in the United States and denominated in US dollars. Examples include China, MCHI, Brazil, EWZ, Japan, EWJ, and Israel, EIS. Others track a wide breadth of foreign markets, such as one that track emerging market economies, EEM, and developed market economies, EFA. Thus, you can see yourself that there is a huge number of ETFs that exist, 8,552 to be more precise, according to data from 2021. Just to put it into perspective, that is more ETFs than there are stocks listed on the New York Stock Exchange and Nasdaq combined. And there you have it, a succinct explanation of exchange-traded funds. Hopefully this video cleared it up for you at least a little bit. If you have any further questions, certainly feel free to ask them in the comments below. Additionally, if you liked the video, consider dropping a like, sharing and subscribing for more financial content. We are just getting started here and there is a plethora of exciting stuff coming. So, thank you very much for watching and see you next time.